Greetings, market rebels. Welcome to this week's macro measure combined with our sector situation video. It's around 10:30 a.m. here on the East Coast. It's Sunday, March 2nd, and I'm Wayne. We're going to get into it right away. Here is our trusty market rebellion disclaimer. Here is our trusty intellectual property rights notice. Here is a quick flash of last week's kind of busy synopsis summary, and I just highlighted and read, I think, a lot of the things that uh, ended up being worthy of mentioning last week. So it was there just because the market had really started showing us possible issues, which is why we went with weak second top blues. Some people are saying weak third top blues, but to each their own. And so there was just quite a few things. We probably adding the fibs that we did for retracements was in the nick of time. So that was probably it. And I just think that the way we've been keeping an eye on how breadth and the sectors were really not doing well and essentially worsening, and then that there was a loss of leadership, and that the defensive sectors were being bid and the more aggressive risk on type sectors were being abandoned. So that's really just a quick review of last week. Like I said, I think getting those fibs in there in the nick of time may have helped. So hopefully everyone kind of had that sense we could have something pretty ugly happening, and we did. And here is this week's summary, and I'm just going to start at the top, and that is that we've got the relief rally at 10% at the top here. And the reason I'm going with that is because I think most of the time, I would say a significant majority of the time, when you get the kind of readings and action we've gotten over the past few weeks and what they produce, how the kind of destruction we've seen so far, you normally would get some sort of relief rally attempt, I would say, in most cases. And the market's trend hasn't been cracked. In fact, the gang did a great job of preventing that from happening on Friday. And then, as I noted on Cocktail Hour, I thought there were conditions in place that I hope to share in the video that I hope to record on Friday, that we could see a relief rally. But as I'm sure many of you know, in the last basically 2 hours, really the last hour or so, the gang really pedaled to the metal, the market right back up. It was one of those farcical things that you see that, again, makes me kind of laugh at the whole random walk argument, but whatever, that's a decide. So I'm just going to go right through things, really pressed for time. So I think it got real. We were talking about, will it get real? Could it get real? I think it got real. Once again, I'd say if you look at the imperfect AAII and CNN Fear and Greed, you're very favorable, I think, at this point for a relief rally attempt. I did note that they did seem to get one started. Now that could have just been, right, you could say, well, that was short covering at the end of the week, and I don't think so. I think it was some of that, of course, and it could be OPEX, and it could be gamma. All these things are there, and to some degree in most expirations, or in this case it was a weekly, but at a month end. So all that's there, but I think what really happened to a degree is that they essentially made sure that the technicals didn't worsen for now, and basically essentially put in a really ugly monthly candle. They kind of saved it with that last hour and a half plus burst. So people might argue that, but I've seen this happen over the decades. I've seen this happen too many times for it just to be random. Just so you'll never sell me on that, but it is anyway. The quick and dirty is that leadership's been lost. We went to risk off. The defensive sectors were still bid the way we talked about last week. The VIX did become more elevated by week's end, and yields did crack, I think, due to money heading for the hills, heading for safety. So the intermediate trend is at risk. The long-term trend, I don't think, is at risk yet. I'm going to just have to chart in real time because I'm very pressed for time. I did not feel well on Friday, which is why I did not record, did not feel well yesterday. So hopefully I'm coming out of this, whatever was bothering me, and I can get this taken care of for us. But I've got a lot of things I've got to get to. I would stick with what we've been ending with. Um, so definitely not dismissing this. We've been reiterating these concerns now for probably 4 or 5 weeks, because maybe even longer, just because the market really stopped having that forceful surge. We saw that there was problems developing to some degree in sectors. We saw that there was some issues with breadth. So we kind of reiterated, don't let them lull you into a false sense of security. And maybe that was, finally paid off. I'd rather be early than late. I wouldn't say that we went bearish or anything. It's just that right. I try to really say, like, okay, what kind of environment are we operating in? And I think we were operating in one that was not easy, right, for about a month plus. So yeah, it's tough. It was tough, and you really couldn't tell what was going to happen. Long-term uptrend, but with problems developing, usually you're going to go with the uptrend. But I think there was enough happening between the econ side, the geopol sign, the technicals within the market, all that to kind of definitely put you on alert. So I'm not getting into it. I'm not an expert in it, not an expert in anything, but I'm certainly not an expert in what's going on with NVDA and the accounting and all these other things that are happening there. And folks continue to put out more and more stuff about how there's some clownery happening there, and it looks a little shady. And maybe I'm just an untrained eye for that stuff, but it's sort of resonating a little bit with me, just because of the way that SMH disappointed, the way that NVIDIA disappointed, not in terms of their report. I don't know much about that, but I mean just the way they've been behaving, right? So that's maybe we should give that a little more credence than just dismiss it. Something folks might want to look into if they want to see what's up with one of the biggest names in the market, and certainly the biggest area in the market in terms of maybe the importance going forward. So I think it's still serious. If we do the news neutral assumption we come in, I would say the most likely scenario is a relief rally with volatility. So I think there will be a relief rally attempt. That's what people really want to hear, that you're definitive. But I mean, I think that is what's going to happen. How far it carries, right? I do things iteratively. So I let the market feedback loop work, hopefully in my favor. So I'm going to keep an open mind and see what happens. If they really bounce this very strongly from here, then right, maybe the worst is starting to get behind us. If they really have a struggle and put a really mild bounce together beyond the shenanigans of Friday, late Friday, then that's really not a good sign, right? So we'll take a look at some fibs. It'll be a little messy, but there's nothing we can do about it, unfortunately. So we'll see how high they can lift. And that's if we can lift, right? And the reason for that is I'm saying that I think it should lift, but right, number one, news itself could dash our hopes of that right away. Right? We don't know what's going to happen over this weekend or by Monday morning when the markets reopen. So, but I do think if they can lift, they should lift, and I do think most likely they will. I would put it at about the 70% chance that, ballparking it, of course, that they try to pull something beyond to extend Friday's relief rally. Let's put it that way, and we'll see where it goes to. I would still be there with high DEFCON. I think again, if this semi story really turns out to be a lot more smoke and mirrors than probably most people would have ever believed, that's probably a big problem. And there's a lot of and you might say, well, I don't know, there's still a great future, and you may be right. But the fact that a lot of people invested on that, a lot of people are on that one side of that boat, and maybe some sharky type players are on the other side, and that can create short-term pain. So it's not like the market always operates at max efficiency in terms of the right valuation, right? It overshoots in both directions. So when that could cause more selling if more people that are on one side of that boat start to feel even more pain. Anyway, the Esterhaus warning, which is kind of redundant with DEFCON, it's still there though. You have to be, when you start seeing this, you don't know if you don't know anything, right? You don't know if you're even going to get the relief rally. I think probably should happen. But assuming that we do, it doesn't mean you're out of the woods, right? It could just be a relief rally. There could be a whole nother leg lower. We just don't know. And again, that's why I'm going to go back to iterative charting and then see what happens. So if we put in a lower high, we roll back over, then we'll be looking to see if the lows get taken out that were just made this week, I guess on Friday. And then if they hold, right, then we're going to say there's a double bottom, and then we're thinking there you could go back up again, right? If the sellers can't knock it down. So that's why we try to stay nimble. That's the probably one of the main reasons I try to do these videos, aside from trying to help folks get a sense of what kind of market environment we're operating in, is just to remind people of certain things that I learned the hard way along the way. And that is that you just have to be nimble in trading. It's a little different than investing, I think, in the long term, to say the least. And so the final thing is really just going to be this stuff I've got to mention. And I think this is the reason why I would say that being nimble or handling things deftly might really come in handy. Might not, but here's how I'm looking at it. And again, this would all be politics aside. So my argument is this: Trump ostensibly, and I do really stress ostensibly, because I'm too old to believe anything at face value, even no matter what, who's selling me what. It's very hard for me to believe that Trump is a paladin. He could be. I'm just saying it's very hard for me to believe that, not really because of Trump himself, but just because of all the lies that we've seen for decade after decade after decade that have really brought the country and the society to the state in which we currently are trudging along in. Anyway, so ostensibly he's a disruptor. He's going to create disruption. That's obviously going to create uncertainty. The market is typically not a fan of uncertainty. So if you ask someone like me, for example, it's hyper everything, you can name it. So if you say, Wayne, do you think there's hyper rigging of economic statistics? I'm going to say without a doubt. If you say, do you think it's hyper corrupt in big pharma and the government? I'm going to say yes. So one way to just kind of across the board it is to say, right, do you think there's hyper corruption on Wall Street? Yes. In the banking sector? Yes. Here, there, and everywhere? Yes. I think everything is hyper corrupted at this point. It's been this way for a while. I think only now you're starting to hear more about it, right? I think for the longest time it was denied and dismissed. And I remember seeing it denied and dismissed, and how everyone that had a problem with whatever the powers that be were doing was essentially a conspiracy theorist, and they were using that pejoratively. So it turns out, if you were on that side, a lot of the things that you were concerned about seem to have borne out, and maybe you were just too far ahead of the time of the reveal, courtesy of the Mockingbird media. But again, having said all that, I would say everything's hyper corrupt, and ostensibly Trump is going to disrupt this. That's the narrative that's been painted by certain factions. And so if the full truth were ever known, I would say that it would still shock people. So I think it's a lot worse. I think you may as well say that I don't know if this word is even a real word, or I just concocted it, or someone else did and I read it, but I would just say, like, we're just living in a kleptocracy at this point, right? That's been my position for a long time. So I think that's how bad it is. But still, I think if you really got the full truth on everything, it would still even shock people that think and have thought that things are really bad. So if you extend this kind of thinking further, which again may not sit well with people, but I'm keeping politics out of it. I'm just saying this is the story that's out there. And so the entire system or systems are potentially at risk. And so if you think about it, this system has worked really well. If you go back to the latest financial crisis that the Fed and the government helped cause back in 2006, 7, 8, all those 9, all those great years, you'll see that their fingerprints are all over it. And that was really a lot of Wall Street shenanigans really helped create that. And essentially, they never had it better in the years subsequent to that, right? So in terms of all the clawbacks that were promised, I can't remember anything being clawed back. Maybe a few slap on the wrist fines. That was it. And it never got better. And really, this is working for them. The inflation is working for in their favor. The way that everything works right now is working in their favor. They've got it structured, all of them, in all these different areas of hyper corruption, have it all worked out. It's been gamed, locked down, whatever you want to call it. This is just how I see it. So that's why I would say, ostensibly, if Trump is who he is supposed to be, I wouldn't rule out dramatic events. And I will say, like, I've obviously been dead wrong about that, right? Where now there were some in terms of, I guess you could say, the assassination attempt. But I meant even after that, I thought there'd be a lot more things that were to happen. I still think that just because it seems like that's the name of the game these days. There's one side, not that there's even two sides, but one side or one faction pulling against the other. So I think there's still that possibility. So I wouldn't rule that out. And that really brings me to, I think you have to trade the reason I'm going into this, because I think you have to trade even more deftly during volatile news driven phases. I think that's the whole reason really that I'm talking about this right now, because I just get the sense that with a lot of new folks having joined Market Rebellion, they're not aware of how they can hedge so easily. Essentially, hit the pause button, the way I like to describe it. There's various strategies. There's all kinds of things you can do. I believe Market Rebellion even was giving away or bonusing some course that Ryan did with respect to portfolio hedging in different ways. So I would inquire about that if you're unfamiliar, because the last thing you want to do, right, is work hard to get a really good account built up through really good trading over the course of time, and then give it all back if something really disruptive does happen. And it could, right? We don't know what's going to happen. We don't know if this is all legit. We don't know if it's just a lot of hype, right? Where this Fort Knox type stuff is what I'm talking about. We don't know if that will get anywhere, right? We don't know if some of these other things that are bubbling around out there will get anywhere. But if they do, it could be a real disruptive situation. So you may say, well, these are still great companies, but why take the ride down if the disruption is going to cause and trigger selling? Why take the ride down and give so much back on your investments if you don't have to? Now, I hate to see that, and that's why I mentioned that. So on that note, I'm going to hit pause, and we're going to reposition and just talk about the charts. But that's my motivation for it. I just hate to see people work really hard in anything and then really have a major setback. And that's something I think could happen. I think Jeff Garbus, our short interest guy, he put that forward in terms of the gold or the metals trade. I think he was mentioned that on Cocktail Hour. Essentially, right? If the gold isn't what it's supposed to be at Fort Knox, I don't know how they just do that with an inspection. I mean, I think you need a real audit. Like, you really need to go in there and you audit the whole situation, not just inspect it. Like, I could be wrong. I mean, inspection sounds light to me. I could be wrong. I have no idea what they have in mind, but his thinking is right that you could have a massive jump if those gold stores have been depleted in some dramatic way. There could be a real repricing of gold higher. Could be. I don't know. I mean, I'm not a gold market expert at this point, so I don't know. But I'm just making the argument that with this kind of stuff happening, with theoretical friction between Trump and the Fed, he and Powell, all these different things, with the friction with Europe, the friction with NATO, the friction with the WHO, the World Trade Organization. All these things, whether you like them or not, are just possible sources of really, right, disruption, uncertainty, and that really is not. It's the typical meat and potatoes that the market likes to rise on. Put it that way. Maybe I can get a few more cliches in before we conclude. But what I've done here is to get right into the first big dog ETF, the SPY. I did get started with this. Looks a little messy, but what I'm going to try to show is that this is the sort of long-term trend. Long-term trend is This is what I would kind of call the intermediate term one here in white. Let me get back to the pointer so I can highlight that line, that support line. So that's where I think the save came in on this weekly chart right here, because I've got this anchored in a couple different places, and you can see that they came in, you were below it, and the gang brought it right back up to it. And they made sure that the candle, this is the weekly, I'm sorry. Yeah, this is the weekly. So I was about to say the monthly candle wasn't terrible, but that's really where the save happened there late on Friday, because that's how far they rushed the week back from where it was on the low, really on Friday morning or Friday afternoon. So it was a real goosing at the end there. But that's why I said on Cocktail that you're at risk. You just don't know if you're holding yet or you're breaking. And so they held it above that support line there. I might be tough to see. I apologize, but I'll try to maybe dial in a little bit more, since this is pretty important, and get this a little bit bigger. So yeah, you might be able to see it better. So I would call this still kind of the intermediate term trend. You're still way away from, on the weekly basis, right? That we're looking at weekly candles. You're way away from the 50, which is right going to be close to the 200 or 250 day. And so we can go to something. We can go to something. We will go to something on the daily. But looking at the bigger picture, right, here's the biggest picture, or one of the bigger pictures. And I keep having the same problem I always do between Trading View and Think or Swim. I get so used to Trading View that I think, right, if you look at this monthly chart, it's hard to say that the long-term uptrend is broken, right? So that's why I wouldn't say, like, you could see where the support is if you drew a line, or you could even use the 50 month, if you will, down here in gold, right? And that's not broken. So that's another interesting thing, is that we're getting these super high bearish readings and lack of bullish readings in AAII, and super fearful readings in CNN Fear Greed. And you were at the time these were registering, you were 3% away from the all-time high. Not normal, right? Normally you get those super high readings near lows that are usually pretty good buying opportunities for the long term. That didn't happen here. So this to me, I wouldn't go ahead and say, well, it's over, right? It could be. I'm not saying it isn't. I'm just saying that I don't think you can say, oh, the whole long-term trend is cracked. I think it's more of an intermediate term trend that's at risk of cracking, because of when you look at it big picture wise, like we just did. So I just want to make that clear. And then as far as the daily goes, we'll go back here to the weekly chart. I'm sorry, the daily chart. And this will kind of drill down into right where we were on the weekly. And they brought it right back. That's the line we were talking about. I will turn it blue. It should be blue now, if you can see that. Go back to white. They brought it back to there. It's right near the dash 100 SMA. So that's what they were able to do. Now, I've got two fibs in here. One is the retracement from the high that we made. It was the false breakout to new all-time highs. Then they reversed pretty strongly from there. And again, let me just take this opportunity to warn folks, this is exactly why you have to be disciplined, in my mind, kind of in a visual sense. Because if you trade a breakout, and there's nothing wrong with that, and they work great a lot of times, though they don't always work. If you trade a breakout and it doesn't materialize the way you thought it would or should for various reasons, then, right, you have to really say this is not working, and you have to take a small loss or hedge. Right. This is so important, because if you don't, right, they use false breakouts and false breakdowns to basically deliver strong moves in the opposite way as well. So you can get strong follow through, you can get strong failures. Here's a breakdown of a bunch of market lows right here, right, that they slid down pretty quickly. They basically took out a bunch of lows, and look at the reversal there, right back up. And if you traded this as a breakdown and you just waited, they crushed you. This is why, again, taking these small losses or hedging quickly when it's not working quickly, or the way you thought it would or could or should, that really is one of the keys, I think, to trading, short-term trading. So I don't think that's a big secret, but if you're new, I just want to make that clear. So now we have to say, well, okay, how far can the gang work this back, right? And the more they work it back, the better for bulls, in my opinion. The lower bounce back rate, if you only come into here, maybe that's 50% of retracement from the high to the low, not that great. That would be okay, right? But once if they kind of come up to here and start falling back underneath this line, then there's still a problem, in my opinion. I think the odds are that you might be looking at developing another leg lower. Now, I can't rule out that we can just open up and start sliding all over again and do that for the whole week, for all I know. But I do think, right? I do think they've got more up their sleeve than just 90 plus minutes of short squeezing that they pulled off on Friday to kind of make things look better for the end of the month. So I do still think the onus is on bulls to make the case as to why we should just go right back up to all-time highs. People are talking about how there's now going to be even more inflation in Europe for various reasons. Probably we saw that there was some data here. They're saying that inflation is starting to intensify here in the pipeline again. So the lower rates due to inflation really being dead might not materialize, and you have a lot of consumer signs that are not very good right now. So not a good situation. The seasonality isn't that great into mid-March. So a couple more weeks of roughness wouldn't be out of the question. So just keep that in mind. But that's what I would look for as my most likely scenario is they try to push this back further, and then we see how far they're able to get it. And it might surprise us how far they're able to get it. If you're a dyed-in-the-wool bear at this point, you might be shocked, right, at how far they can work this thing back. But all they really need to do, again, is to create a couple of important news stories that a couple of big names, some of which are oversold. They'll get really good bounce back from those. That'll lead others, and then suddenly, right, everything's right back up, and you're like, oh, you get all the people coming out of the woodwork. What were you worried about? But there's a lot of reasons I think that are legit to worry right now. And one of them is certainly the Trump stuff we talked about earlier. Whether you like it or not, I'm looking at it apolitically, saying it might be a great long-term thing in some people's eyes, but it could definitely hurt due to the uncertainty and disruptive factors in the short term. So there you have it on that. So I would say, look to see where it bounces. The more of a bounce, the better for bulls. The more we stay around here and don't do much, and then maybe start sliding, not good. And I really don't know what the catalyst would be for why this market would just suddenly start to rally strongly, other than news stories that develop probably seemingly out of nowhere, which could happen. But note that these shorter term SMAs up here are all starting to downslope a little bit. And so it's been a while since that happened. Last time we got that kind of rollover was in here, and you could see there was more to it. And usually when you get that, usually right after there's been a failure like this to really go anywhere, and that you could end up with a rough situation. So just keep that in mind as well. Even the 50, the golden line, is downsloping at this point. Not terribly, but it is. So I would think, right, if it comes up into here, gets bottled up, can't really get back above 600 and hold there for too long, starts rolling over, that means, right, you may have another leg developing. And we'll see, but otherwise, right, we have to take it as it comes. And for all we know, they'll make some news in, Google or maybe Microsoft and Apple, Meta, whatever, and then they'll get a lot of these things rocking and rolling. And we can't say, for example, that, right now, we can't say something like NVDA, where it was on that morning, that it wasn't, you could see this massive reversal. So it was probably getting closer to, excuse me, oversold, but they didn't really let it get there. You closed at 38 on Thursday, and on the lows, you were probably getting RSI readings in the lower 30s, probably at that point. So the fact that they did this has taken it out of really risk of being oversold, or it's taken away the favorability of that. So you've got this sort of potential double bottom esque type situation here formed in NVIDIA. I still think that if you look at the longer term, it's hard to like what you've seen because, right, you're really, this is, you've been correcting now for some time. It hasn't looked good. These stories are still out there. So this is at risk. It really has its work cut out for it to work back up and through. It would still take a really nice, maybe like 10 or 15% move to get back up to where you think it can start making a break for the highs. But you just can't rule that out. It just, this has not been a good phase for it. But they've managed to hold on, right? So far, they've managed to hold on there on the weekly. But I think right now, the sellers are in control of that stock until we see it do more, right? I kind of would take the lean to the downside. This is not for short-term trading. I just mean kind of intermediate viewpoint on it. And that's a very important stock. So, and obviously SMH is a very important ETF. And that's also been in control of sellers for some time. I think this remains in control of sellers as well. And I would say you've got to wait on that, right? You've got to wait on that. You're probably looking really to start feeling like you're in the clear. You're probably looking at 260, and that is going to be about 10 to 12, maybe more percent, slightly more percent up from here, where it closed on Friday, to start feeling better about it. So it's not out of the woodwork. You can see the triangle we've been charting. This is on the weekly. You can see how much hay they've been able to make out of it. It really jumps out at you on the daily, though. If you look at the daily chart and you see what these guys were able to do with this really heavily followed and traded, widely followed, heavily traded area, they've been able to create all kinds of false breakouts and breakdowns. So we can't be shocked, I think, if they try to make it look like it's about to get smoked and then reverse it back up a little bit. Certainly can't rule that out. I do think the conditions favor that. So let's jump over to the Qs. We'll do the fib levels there too. Oh, you know what? Let's mention the next fib down in SPYs before we do that. My bad. I meant to do that. So let's go on the daily and we'll pull these fibs up. And I would say, I think we talked about maybe a 585 level as a flat line. I can't remember. I might have gotten that confused, but I think we were talking about there's a flat line there. And I was thinking that's where it could get down to. The low of the week actually got down to 582.44. So it slid below there, but it managed to recover. So it's kind of a draw on that. But I think your next big fib level is really going to be the 38.2, which is the first natural one, if you will. And that is going to come in at 574-ish. And I would argue, right, that's probably just about where the rising purple 200 day will be, should it fall to near there. So if you're looking for, well, where would be a great place to maybe think about buying, especially, right, if you put a feeble rally together, you plummet pretty quickly, then you'd probably produce very oversold conditions fast, from which you could get a trampoline style bounce, which is what we all love to see when we're in a long-term uptrend, is really oversold markets that hold and then start bouncing, and then you get a nice snapback. Now, you always have to evaluate this, right, in light of the news. You have to make sure the environment you're in supports the dip buying. If the dip is being caused by multiple countries threatening to launch nuclear missiles against each other or something like that, it's sort of a different story than a bounce story. So you get the idea. It might be ridiculous, but you get the idea. So I would say that's where I would look into this mid 70s, call it 574 in SPYs. So we'll pretty much do that for the other ones. Then I'll just start kind of wrapping this up. So here is the Qs. Again, they were doing great, and they've had a really rough 2 weeks here. They saved them right near the 150. I think we talked about the rusty rough 150 last week, and you might want to add that to your charts, or the week before. And a lot of times when you can't figure out what is it, was it a fib, was it this or that, it's sometimes when you're between that 100 and 200, for some reason, the 150 matters. And it's just like the other ones to me, where it's like, well, people probably threw this on their charts for the longest time, way back when, people that even bothered looking at charts. And there seems to be sort of like a legacy respect for these things, even if you don't think they make sense. And I'm actually a person that would say that I don't think moving averages make sense this way, but that's how the market behaves. So, I mean, to me, it's sort of a strange thing, but I've never really fought against it in terms of does it have validity in this sense. I'm not a big fan of moving average crossovers and things like that, but in terms of support and resistance near there, I think it's true that 423.45. I think it's true that the markets do tend to respect these levels. So we do. And there's an interesting one there where this is what we were talking about. When you get a combination of different things, you probably could say there's sort of a little bit of a flat line there near 496 in Qs. There was the 38.2 fib. You've got the rising 150 and Rust all in that neighborhood, right? It's all in that neighborhood. So your low that day was what? 496.93. So yeah, you were only just a point away. So that's why I always say bid in front of or offer in front of your levels, right? Because the more important thing is if you were riding shorts for a while here, the more important thing is not to get your price, to get your fill, right? You had a good score, and there's no reason to get silly over a few extra bucks when you've had so much money at risk. At least do a roll. If you don't like a roll, do a trim and a roll. And if you don't like that, just close and take the money and run, and then reevaluate. Maybe you need to get back in. Anyway, I would think let's do another fib here in terms of a retracement. Make sure I got the right one. We are going to try to put another one here. So we'll do this. No, it won't let me do that. I think I have to come up here and do that. And then come to here with, oh, it doesn't. Oh, maybe it will like that. Okay. Let's see. So I've got to adjust that one just to see how far it can go to. So we have to go back to 81, and then we have to do what's that low? Was it 4? We said it was 496.93. So I've got to get that there. And then we will see where that leaves us. And that's going to be interesting because if they do bounce this back up towards the 100, the 100 is going to dovetail with it looks like it dovetails with the 38.2 bounce from the high to the low. So if we bounce up to there at, looks like about 514-ish, we're at 508. So if we bounce another 1.5%, basically, we will be near there, roughly speaking. And that's probably right the first area to look for. Next one up would be right in here at near 519 to round it off. Now, down the downside, I think, like I said, I think you have to look at this 200, right? The 200 here is probably your next big level. And then beyond that to the downside, if this market really fails to rally, I think you've got to look at that retracement of the whole move from late summer all the way to this year's recent highs, new all-time highs. That's going to be 482. So that would be another pretty good drop from here, right? It would be what, 18 and then 8, so 26. So we're looking at about 5% more, roughly speaking. So yeah, that would be a pretty good drop from here, and that would probably chase out a lot of people at that point. So, and I believe that the CTAs are still net sellers of rallies, is what I read. Now, I can't confirm that. I don't have that data, but that's what I've come across. So the commodity trading advisors are going to be net sellers. And that usually puts until they're done, that can really put a lot of supply in there, extra supply in the market. Let's take a look at the diamonds. And we'll do the same thing. Diamonds have held up decently, I'd say. Not perfectly, but decently. Thinkorswim's fighting with me here. Not a good sign. And boy, oh boy, is Thinkorswim's being rough here. I might have to zip out to a quick weekly for us to get us a retracement from the summer lows. That's what I'm working with. So we'll do this. Here's your summer lows that I'm working with is this wave up. And okay, let me get that dialed in for us. And it's going to be 451.55. And the low is what right there? 384.93. And then we'll just go take a look at that on the daily so we can see it better. And you can see that, right, the give back was bigger, far bigger here, right, from that high. So right now we're still not even at 38.2 retracement on that. But you notice in here, you've got all your shorter SMAs rolling over, 50s flatlining. So a little bit of an SMA mess there, a little bit of an SMA confluence zone. So just be careful with that. That way. In terms of bounce back, I don't even think it's worth putting a percent retracement on this because it's been so minimal. So I would say to cut it to the chase, I would look at that 20-day, that blue 20-day at 442.34. So 1% to the upside. Get through there. Maybe things start improving. You switch right back to bull mode in a way because you've got this high, this deeper low, similar high, more shallow low. You end up with sort of an ascending triangle if you start working your way back up towards the highs. So, and you still have your long-term trends, even on the daily, are all still uptrending, right? So you don't want to get too bearish on that just yet in terms of your just general view on it. Technically, I don't think. I would say that's holding up relatively well still. So big issue downside wise, probably have to go with the 150. 150 and the 38.2 are at 426. So that's another, what, 3% down roughly from where we closed on Friday. So that's your next level. And then beyond there, you hit a nice dovetail with the 50% retracement from the lows of the summer, right with the 200 in purple. That would dovetail nicely. And that's at 418. So I think your big levels are here. You start not worrying really much at all if you're able to get back above the 20 and hold there. And to the downside, we just talked about them. That leaves us with IWM, and I'll do a quick just commentary on the sectors and quick commentary on a few other things in the breath, and we'll wrap it up. If you can see, all right, this is what we talked about, how this being more vulnerable to problematic situations. And these really did make a new low. You've got to go back to last year to find something like this right back here. And it looks like in SEP. So IWM looking worse for the wear. I think the IWM chart looks pretty bad. You have to think, I think, with that kind of reversal they tried, I think there's going to be an extension. Definitely got down to oversold. The RSI going out was only 34. So you know at the lows, it was very close to 30 probably. You're going to be maybe tapping the 200 from the underside. If you get back up there in purple, you've got your SMAs rolling over pretty hard. And the shorties are all rolling over, and even the 50 as in the 100 starting to. So I don't think that looks very good at all. There definitely still could be, in my opinion, there could definitely be a whole nother phase where you move lower here. So I think that looks really rough, bigger picture, sort of intermediate term. But in the short run, I would say that it too should probably try to extend what may have been the start of a relief rally a little bit more. And I would think that's the big juncture. Can it get to the 10 and the 200 and go through? That's only a few percent higher. It's right near 219. So you're looking at what, maybe like 2%, slightly more than 2%, not much. But I think right with all these rolling over, probably going to be tough. Right? There's going to be some headwinds for this, and that's not good. Not good, not a good sign. I think that's kind of more reflective of what I think is really happening in the economy versus what they've been trying to tell us is happening in the economy. So I think it's worth dropping a fib on there. Let's anchor one right here at those. Oh, that's too far back. I forgot we were on weekly. My bad. We got to get back to the daily. So yeah, I want to anchor it here near this low. Wow, it doesn't like that I was on another indicator when I did that. Let me get it to here. And let me put it up to 244.98 and we'll see. We have 244.98 we need to work with on the high side. And then we have on the downside, what's our low there that we're working from? That is 197.41. So let's get that done. And then this will give us, right, the retracement percentage of this recent move off of those lows. And I think you could see, right, even on the fib basis, you've already retraced more than 61.8, right? So this is weak, like we've been saying. Your next one is 78.6, probably right where the flat line comes. Flat lines are going to come in right near there, which is 208-ish, right? So that's another, what, 3% to the downside. So if it does bounce, then it would be about 5% to the downside, kind of like I think what we saw in the Qs. So we'll have to take it as it comes at us. If they somehow get news that works it up and through all these things, that would be the surprise. It can't rule it out, but I would expect it to have some rough sledding, given how it has looked so weak, and given how maybe yields aren't coming down, and given how maybe the economy isn't all that stellar, and given the technical picture in the mix as well. So probably worth quickly noting that the VIX remained elevated. So did not go into full retreat late in the week. Did retreat, of course, with that burst, but didn't go full retreat. So worth keeping an eye on, because the VIX finally showed a little bit of moxie, and it hasn't shown much moxie for a while. And then here's your yields dropping. We talked about these possibly cracking, and I think we had this line in here, that purple line that's a remnant of that from maybe the last time we talked about it. And I'll just tidy that up a little bit right there, and I'll tidy it up right there. And that did crack. I think this really obviously has to do with the flight to safety. So these are rolling over. Again, this would be in a good thing if I think these would come down in the sense that it would help the economy, clearly, that would have lower rates. But is the reason why that is looking that way, like it could do that, is it really more just about people just going completely exiting stocks, putting selling pressure in stocks, and then getting into a safer investment in the form of the 10-year note? We shall see. Want to bring in the quick view of the market breadth. So the market breadth quick view is, it got, because of Friday's shenanigans, it definitely got better. Where's it? It's not. Why is it not showing? It's giving, something strange is happening. Oh, I'll try to move this over. There it goes. I don't know what just happened. I guess Thinkorswim's doing the Thinkorswim to me, but not really a great look across the board in terms of right, your new lows, normalized new lows versus new highs. The net right here, just net. But you can see, right, that suddenly, right, one day later, there's this big upturn. So I think that's another reason why I would say they're probably going to try to do more with this rally. They did step in, and someone launched sort of an across the board, let's buy them up type of a thing. It's probably worth noting that the chances are that Buffett wasn't part of that, from what I've been reading at least. Buffett is apparently more in cash as a percent than he has been in a long time. I think someone even said ever. I don't know if that's true, but I did see that in a couple of ways that it looks pretty high. So Buffett, apparently at these valuation levels, not a big buyer of many things, supposedly. So that's interesting. But I think, look, the breadth was looking pretty bad, and they really started to come in late. So again, I would say that overall, it's not great, but it's taking that turn. And at this point, given how overdone we were in the short term, I do think that there still should be a little bit more of a relief rally. But I mean, to say that the market looks really healthy, that would be a fib. That would be a pure fib. So let's now move over to the sector views, which I'll have to pull in here from another screen, because I don't like shifting. I don't want to cause any trouble between Thinkorswim and Zoom. Anyway, I would just make the general point that we have been making is let's cover the defensive sectors. Okay, here's healthcare, here's real estate. People thinking that's defensive is interesting, but whatever. And then here is staples, and there's all those all held up relatively well. You can see that even XLB and XLI, maybe a couple Dow type related things, which is maybe why the Dow doesn't look too bad. They also held up. Now, maybe part of that could be due to maybe inflation helping out there. I don't know. I'm just throwing that out there. But that all looked better. This was looking rough in energy over here, but they went ahead and you put that really strong Friday together. Interestingly, the financials really powered back up and really aren't that far off of the all-time closing high, literally pennies away. So we did get some financial and energy hits that were bullish inside of this really kind of volatility maelstrom, and we went with them. We had to, right? You have to anticipate that there could be some sectors they head for that have good looking charts, that have UOA, that are holding up okay. We got those ideas in. I don't even know how well they did. I'm just mentioning it, that they came nibbling for these, and they turned out to, apparently, at least in the sectors themselves, turned out to be right in the short run. But your leadership sectors, your communications on the bottom, your technology here, you can see they look rough. That's important. But XTN also looking rough, another important sector, and discretionary still looking rough, all saved on Friday. So it's kind of a mixed bag where I think these two important sectors up here did a little better towards week's end. The other ones that I look for kind of more risk on, things are looking good. XLY, XTN, XLC, XLK, they all, by the end of the week, it looked a little better thanks to that Friday burst, but really not that great overall. So an XLU just did, XLU type things, honestly, overall. So I think that's really the wrap, because I don't want to go too deep into other things, and I know we're probably chewing through a lot of time. Let me see if I can bring up the final chart and see if there's anything else that comes to mind. I think mainly, that is not the final chart. This would be the final chart right here. I think mainly we covered it. I'm more in relief, as you know, more in relief rally, and I'm more into, let's see how that behaves, how far they can take it. There was really, we just saw, there was a really big bump up there in breadth. So I do think somebody did step in. I don't think it was a coincidence. There's a lot of reasons, as we talked about earlier, but certainly making the monthly candle close a lot better on some measures was definitely a part of the mix, in my opinion. And now you have to wonder why this market, not that you would fight against it if it did, but what's the catalyst? Why should this market move right back up and start challenging the all-time highs? I wouldn't rule that out as a possibility after this turmoil ends. I just want to know why this would happen in the next couple of weeks. What's out there that's really looking good to really propel the U.S. market right back up again? I don't know. It could be something. There could be something looming. I don't know what it is. I've asked that in one of our webinars in the past week. I don't really, not that people's answers were bad. They were probably pretty good guesses, but I didn't see anything that really struck me as, yeah, that could do it. I saw, things that would sort of, I feel like they're already known by the market. Sometimes though, they do use things that are known and they just recycle them and say, oh, look, this is new news, and react to it these days. And they get away with it because Fin TV, AKA Bubble Vision, is really not all that critical, to say the least, of the kind of stuff that gets peddled. But yeah, but anyway, I don't know what that would be, but we have to give them the benefit of the doubt. I think that there's a relief rally that should extend because, as we saw, intermediate trend, they could easily get it right back above there and try to do some work. Long-term trends just not cracked yet. Intermediate, I need to see the intermediate crack before I can worry about the long-term cracking. Short-term trend clearly cracked. Intermediate at risk of cracking. So we'll see. Yeah, like I said, seasonality not all that great really until for the next few weeks typically. So I would say that's it. You're just going to stick with it, knowing that Trump is a newsmaker, for better or for worse. That's where your trimming and rolling come in, I would say learn all about trimming and rolling. You can ask me or Ryan or Greg about what I call the quick trim and roll. So whatever in one of the webinars, we'll be happy to recover. To cover that. I should say, I'll recover that again because we've done it so many times. But if you're new, it may help you. I think it's a very good thing to do psychologically, especially in markets that require you to be nimble, even more nimble, I should say. They always kind of require you to be nimble practically. So on that note, I think I'm going to wrap up. I'm going to thank everyone for tuning in. Hopefully these videos are helping out. Hopefully last week's video helped you out. Hopefully this one will help you this week or some week in the future. Now, again, I want to thank everyone for tuning in. Everyone take care. Until next time.